We warmly welcome all of you on behalf of the IBSL, Institute of Bankers of Sri Lanka, for this program, Diploma in Treasury and Risk Management. Actually, this is a professional qualification recognized by the Central Bank of Sri Lanka under the Banking Act number 6 of 2019. When I tell about the IBSL, prior to commence this program, the IBSL is established in 1964 and it's actually recognized by the Parliament Act as an education institute, and our governing board members consisting of the CEOs of the most of the banks, including Central Bank, Bank of Ceylon, National Savings Bank, Sampath Bank, Ceylon Bank, People's Bank, like that. Our chairman and vice chairman are from the Central Bank. They are deputy governor of the Central Bank chairman, and the vice chairman is assistant governor of the Central Bank. They are the one who decided which type of programs IBSL has to be conducted. Our core programs are IABF and DABF. Hope most of you already followed by these programs. And in addition, we are conducting postgraduate executive diploma and bank management course. It's open for the graduates and the diploma holders of the IBSL. In addition, we are conducting this type of diploma series. Normally, we are conducting 1 or 2 diploma per month. We are commencing, and totally we are conducting this type of 15 diplomas per annum. When we come to the Diploma in Treasury and Risk Management, it's consisting of 6 modules, and total duration is 116 hours. It means you have to be with us on Sundays morning, around 8-9 months, and its evaluation is based on final examination, assignments, and project report and or presentations. The marks allocated for the final examination is 80, and assignments 10%, and also project reports 10%. And the gradings, when I tell about the gradings of the final results, 81 or above, it's a distinction pass, and for the merit pass, you have to be obtained minimum 65 marks, and the pass mark is 51. I would like to tell about the resource panel of the program. Our core resource person is Mr. Nishant Chayavira. He's from the Central Bank. So he's the Deputy Governor, Deputy Director of the Central Bank of Sri Lanka in the Risk Management Department. Prior to joining the Risk Management Department, Sir was in the International Operations Department. So has the vast experience in this field, and qualification-wise has the MSA in Financial Economics from the University of Birmingham, and the BSc, basic degree BSc from University of Sri Chavadhanapura, and also so is the Chartered Finance Analyst CFA in qualified in 2009, and ACI Dealing Certificate holder. So is the resource person of the IBSL during last 10 years, and in addition to this program, so is lecturing most of our programs, and also has given his support and services to the IBSL for the examination works too. The other resource persons we'll meet during this program are Mr. Nuwan Vikramasinghe. He is also from the Central Bank. So is the Senior Assistant Director, International Operations Department of the Central Bank, and Mr. M.B. Sajun, so is the Senior Assistant Director, Bank Supervision Department of the Central Bank of Sri Lanka. These are the things I would like to tell about the program, and I would like to invite you to be with us during all Sunday mornings till the end of programs, because the thing is, you have the most experienced resource persons to share their knowledge and experience with you. Therefore, please attend the lectures regularly. If that's so, it's not a difficult task to complete the examination. With telling these things, I would like to invite our resource person, Mr. Nishanta Chayavira, to commence the program now. Thank you.
Good morning, all.
Good morning.
Good morning. Good morning.
You can hear. So, first of all, I would like to thank Mrs. Godakanda for the kind introduction. So, those are the basic introduction of the course, but I have a small presentation. I will take you through that presentation and give a little bit more introduction, and at the beginning what I have to say, mention you, highlight you for your success. Can you all see the presentation? Or you still see the video? Can someone comment, please? Can you see
Still video, sir.
Still the video. Hope now you can see the presentation.
Yes, we can see.
Okay, good. Again, I welcome you all to this course. Let me take you through what are the objectives and what do we expect from you during the course and at the end of the course. You might have different objectives. If it was a physical classroom, I would ask everyone to explain why did you choose this program. But in this environment, I think it's not appropriate, so I would skip that part. But I'll post a small survey. It was there, but for technical reason we had to remove that. We will post it again on the classroom. Please respond to that, because first of all I would like to know your background and the level of understanding that you have on banking, and this basically this is sort of finance side, maybe a little bit on economics as well. So what is your knowledge? That will help me to tailor the program to appropriate to your level and give our best to you, so you can make use of it and get out of the everything that you need from the resource panel. So basically the objective of the program is to make awareness of the candidates, improve the awareness of the candidates, because we hope you have some idea about banks and the financial sector, but they specifically create awareness among the on the financial markets and treasury operations and related risks and risk management activities. That is the broad objective of this course. So at the end of this course, you should be able to explain what is the role of a treasury in any institution. It can be a bank, it can be a corporate, so maybe other financial institution, it may be an insurance company. What is the role of the treasury in any organization? What are the structures and where this treasury operates, especially in the financial market? So therefore, the behavior of financial markets, what are the instruments available, what are the risks of these instruments, and how do you mitigate those risks? What are the risks that you should take? Those things you should be able to understand, and at the end you should be able to demonstrate that you know those things. That's the main objective. So if I move forward, there are 6 modules. We are going to start with financial markets. The first module is financial markets, but before that, after this presentation, I'll start with treasury operation introduction presentation, because of first you should know what is a little bit on Treasury, very brief introduction. Then, as I mentioned, Treasury works in deal with financial markets. So therefore, before we discuss about Treasury operations or the Treasury management function, you should have knowledge. You should have knowledge on financial markets and the products, their features, their risks, and things like that. So therefore, we'll start with financial markets, then we'll move into Treasury management function. What are the activities a Treasury should carry out? What is the structure? Then with that, you may need to discuss about risk management activities. Therefore, we may need knowledge on derivatives. So then we move into the derivative markets, and the key function of one of the key functions of Treasury is the asset liability management. How do you do that? What are the key features? Then, with all these things, how do you manage your risk? Not only that, when you are in a market, play around, there can be regulations or laws that you have to be in compliance. So therefore, as the last module, you will learn about what are the regulations applicable, especially in Sri Lankan market, and what are the compliance that you have to comply with. So that is the main 6 modules and brief introduction for each of these modules. So in front of each module name, we have allocated or given some number of hours, but there's no hard and fast rule. This is a guideline. So as Mrs. Godakanda mentioned, the course is designed for 116 hours. So basically it's about 28-29 weeks, but practically we may not be able to exactly cover 4 hours within a day, because maybe some technical reasons, there may be delay in start. We take a break in between that. So whenever there's or whatever the topic that we discuss comes to an end, if we don't have enough time to start a new module, so we will stop early. But sometimes it may go other way around as well. We will move a little bit more than the winding up time. So likewise, the flexibility is there. And other thing, most important thing is that depends on how do you grab those things. If we think we have to spend more time on a particular topic, particular subject or particular subject matter, we'll do that. So therefore, the duration of these modules may vary when we move forward, depending on your capabilities and what do you demonstrate during the class rules. So about the assessment, director explained that, director of the college explains this is the assessment criteria. There will be an examination at the end of the course. Marks allocated is 80 hours. Duration for the final exam, 3 hours. Then there will be 2 sort of one is assignment, the other one is a project or with a presentation that you may have to carry out. Again, we'll let you know when it comes closer to these assignments and projects, what is the exact procedure, because with this new normal environment, we'll have to think about what to do, because previous back we used to group you into different groups, then give the assignment, then the group has to come up, each and every group has to come up with their report and do a presentation. But last year we couldn't do that. So let's see this year what we can do. But most probably even in this environment, we may try to group you into 4 or 5 groups and do the same thing. When we get in closer to this assignment, we'll give you exact details. However, maybe at the end of first 2 modules, you will get the first assignment. Then after the 4th, 5th module, we'll give you the second assignment. Generally, we give you 1 month period for the submission, and there will be penalties for late submission. So those things we can discuss later. Then the grading, this was explained by Mrs. Godakanda. So I'm not going to discuss that again. Any questions? So this is very important. When I conduct the class, I will ask this question from you. I will ask whether you have any questions. Even whether I ask it or not, if you have any questions, please feel free to ask questions. Not only that, I will ask questions from you about the topics that we discuss or the topic that we are going to discuss in the future, or what we discussed maybe few weeks back, because this module or this course, everything is interconnected. So you cannot take financial markets alone or the treasury operations or alone, regulations alone. There are interconnections. Whenever we discuss the very first topic, we may have to link to the something in the in treasury or derivatives or things like that. So therefore everything is connected each other. You should have the knowledge on that, what we discuss. So therefore I will ask a lot of questions because I want to get out of you what you know, what you don't know, then what are the areas that I have to address. So please respond to these questions. Don't wait until someone else respond to that question. And now, since this is online, don't worry. Anytime, if you think you didn't get that concept or it is not clear for you, you have a doubt, please ask. Don't wait because of all others are pretending that they have understood. So I should not ask this question. Don't think like that. When you ask the question, only others also realize that is something that they don't know. Don't be shy. Ask any question. If I know the answer, if I can give you the answer, I'll explain, because there can be questions which I cannot answer, or there can be things I will learn from you. So therefore, when we move forward, we'll make it a two-way conversation, not just one way. I'm speaking here, you are listening there. No, not that way. We'll try to have a dialogue and build your knowledge. So whenever I ask whether you have any questions, please ask questions, anything that you have. Even without that, anytime you can interrupt me or even other resource persons, you can interrupt anytime and ask your question, because ultimately you should know, or you should have the knowledge what you learn, not myself or the other resource person. So you should be ready to sit the exam and pass it. Whatever the objective or whatever the reason that you joined this program, one thing sure, that is you need the certificate. You want to pass this. So for that, you have to have the knowledge and understanding of these concepts. Therefore, please ask questions whenever you think, and please answer to my questions. Don't worry about whether it's correct or incorrect. You might have experience. You learn by doing mistakes, isn't it? We learn things by doing mistakes. So without waiting until the last moment, that means go to the exam and do the mistake. Do the mistake in the class and learn from those mistakes. Then you are ready when you are going to sit the exam. Not only that, even when you go to work, whatever the place, you will be able to apply those knowledge properly. So therefore, don't hesitate. Please ask questions. Please answer my questions. That is what I wanted to highlight. One more thing. What I experienced during last 2 years when we conduct these courses online, you may not, for whatever reason, join the previous week class. Now the video is available, you can watch it, but you don't. Then you join the next class. Don't ask everything from the last class. It is not fair with the people or the other students, those who have joined. So if you couldn't join the class, just go through the video, and during the break or somewhere possible, please raise your questions. Have that in your mind. So I can understand whenever you ask questions, okay, what has happened? But try to ask all the questions whenever we conduct some topic or discuss some topic. Please ask questions at that time. Yes, you review it, come to the next class in the morning. You can ask those questions. Even after that, it doesn't matter. You can ask any question, but remember that just because of you didn't join the last class and you didn't review it, don't try to ask questions and repeat the same session. Avoid that. But other than that, you can ask any question anytime. Most of the time, before I start the new day, I will ask whether you have any questions from the previous week. So take that opportunity, ask your questions, and clarify any doubt that you have. So then the next very important thing, what are the references? What are the resources that you can tap other than the resource persons like me or Sajun or no one? So there are a few books that you can refer which are available in the IBSL library. But this is not a comprehensive or the list. There can be some other books, some other materials where you can refer those things. Only thing is, make sure that the material that you refer have some proper guidance and have some faith on that. Online, you can find a lot of things, but be careful when you refer those things. So this is the way that how you can contribute, or how you can work to your success. So whatever the topics that we discussed here, try to refer a book. There can be gaps that you may not understood properly, or you have doubt. So take a book, read, and try to resolve your problem. You can ask questions anytime, don't worry. But meantime, try to read and understand things. I think that would be the best way to learn without passively attending to a class like this. That can be helpful, but your knowledge will enhance if you read a book and try to understand it by yourself. So this is one of the book that you can refer. This is about fixed income securities, because these concepts, fixed income securities, these concepts you can apply in some other areas as well, in treasury and banking. So therefore, the concepts given in here, it's not only related to fixed income. Some concepts you can apply in other areas as well. Apart from that, FX Global Code, it is about how you should behave. You can refer that one. Treasury Management. This book, all these books are available in the IBSL library. So you can refer to get additional knowledge or clarify your doubts. This is the most famous resource that you have now. But as I mentioned earlier, please be careful when you select a particular website to get the knowledge. Not everything stated in these websites or any other online resource may not be correct or not accurate. So think about it. Then one of the resource that you should refer, I would say you should refer this is the central bank website. This is the home page. If you go to these publications, you can find out a lot of publications. Yeah, you can get statistics from this. Through press, you can find out press release and things like that. Say latest announcement or the numbers published. Regulations, you can find those things. Let me try. You can see this. See, when you go to laws, all the directions, what are the acts applicable, Monetary Law Act, Banking Act, non-banking, other finance, related to foreign exchange, EPF, all those things are available in this section. Directions issued by the central bank in different classifications with regard to bank, non-bank institutions, related to foreign exchange, international operations department, with regard to payment and settlements, domestic operations, who controls the money supply in the economy, public debt, who issues the government bonds. So all the regulations and directions are there. You can find it, or other information. So in statistics, you can find out GDP data, price data, those things. So this will be a very good source or resource that you can have. Not only that, if you are following this course and hope you have some intention, those who are not in the treasury, to move into treasury. Those who are in the treasury, you know what is the environment there, what are the things that you should know. So it's not only about the subjects that you learn here, you should know what is happening in the outside world, not only Sri Lanka, in the global markets, politically what is happening, economically what's happening, or natural events, whether it's earthquake or drought or tsunami, whatever, or maybe a cyclone. All those things have an impact on your operations when you are in the treasury. So therefore, you have to read lot. You have to read lot and act accordingly. So you might see these sort of articles in local newspapers, maybe in foreign newspapers. So see a lot of things if we go back. One is about the bill option or maybe bond option, what is happening in the bond yields, and what's happening in the stock market, what's happening in commodities market, gold prices, other agricultural products. All those things matters. What are the government policies? All those things matters when you work in treasury. So therefore, you have to refer all those things and be update on the environment. So therefore, you have to, I urge you to read those things, not only just the handouts that you get or the presentations and the books or other resources just to get the subject knowledge. It's not enough. You may have to read these news and linked with the theoretical concepts that you learn and predict what would be the outcome. In treasury, it's mostly about the future, not about the history. You should be able to predict the future, what would happen in the future. Then you take actions based on that, your forecast or your prediction. To do that, it's not the prediction, it's not just based on the numbers that you have in the history. What are the events happening now? Or what are the things that can happen in the future? You should be able to make a forecast, have a view on the market. So for that, this knowledge is required. So therefore, again, I make a request, please read these things. Press releases from central bank or other announcements from government, treasury, and not only within Sri Lanka, even what's happening in other countries, what's happening in India, what's happening in US or maybe Europe, whatever. Have some knowledge on that, then assess what would be the impact to you, maybe individually or maybe as the treasury of whatever your institution. See, oil, that's another commodity that have a very influential thing in our economy. So we have to think all those things, and these sort of press releases or announcement made by the central bank. This is about auction on the Sri Lankan development bonds, you might hear these days these words. So basically in this module or this course, what we learn, whatever the very famous words that you hear these days, foreign exchange, treasury bonds, ISBs, SLDBs, SOPs, loans, default, restructuring, all those things we will discuss in this course. These are the things that you have to deal. Now we are dealing with those things as a country. That's what you hear, all those things in newspapers or everywhere. But when you work in a treasury, you deal the same things at related to your organization. You think about bonds, money market placements, reverse repo transactions, money supply, inflation, all those things for what is happening in the foreign exchange market, what is the exchange rate, what would be the exchange rate, all those things that you have to deal with. So those are the concepts behind those. Those are the things that we are going to discuss, especially in the financial market module and the derivative module. Then how do you use that in the ALM and as a treasury? That's the basic. So these sort of articles are written by famous economists or prominent people in the country. Better try to read these, try to understand, and try to link with the knowledge that you have. See whether these things are correct. Sometimes these things may not correct depending on your knowledge. The last thing that I would like to highlight here, this is not to scare you, but this is the truth. This is little bit technical. You have few calculations, you may have graphs and things like that to understand the concept. So as I mentioned, just listening will not help you a lot. You may get maybe 25%, 30% just by listening. Whatever you see on the screen, I have doubt with that you may reach about 40, maximum 50%. If you want to move beyond that, you have to work these things. We do some calculations, interpretations, things like that. So don't wait until I give you the answer. We discuss a few questions. Definitely first few questions as an examples I will do. Then others you have to do it and come up with your answers. Then we'll discuss. Definitely you will get different answers. You will have. Then we can discuss different answers, and then I can tell you whenever you come up with a wrong answer, I can tell you what are the things that you did wrong, where you went wrong. So by doing that, you can learn, okay, this is a mistake that I did. This is the way that I should approach this question. Things like that. What is the topic on that, or what is the concept that I have to apply to answer this question? These things you have to develop internally by yourself. That is not something that I can do. That you have to develop within yourself. So to do that, you have to do. Then you will understand the concept. When you try to resolve a problem, then only you can understand the concepts behind that question or the problem. And even the theory that you thought that you know may be not correct. It may be a different way. how do you apply that theory. So you will get to know a lot of things when you do it by yourself. So again, this is a request. Please don't wait until someone else finish the answer the question, or at the end for me to give the answer. First, whenever you see the question, you try to answer by yourself, then compare it with the answer given. Then try to find out what are the things that you did correct, what are the things that you did incorrectly, and try to fill the gaps. That this is very important, this course, because at the end you cannot remember things and rewrite it on the paper. Definitely this is 80% is based on the understanding, not the memory. So therefore, please ready for that. We will give you all the things that you need. We'll try to explain all the concepts as simple way that you can understand. Still, if you cannot understand, please ask. We'll explain you again and again. Don't worry, that can be done. But you have to have some commitment, and definitely for the next few months, maybe 8-9 months, please change your lifestyle. So when you travel from home to office, what do you do now? Now I think during that time, if you can read something related to this course, it would help you. Or revise, or if you can watch the video again, that will help you. Before you come to the next class, please revise at least the last week subject area that we discussed. That will help you to understand the next topic. And again, I want to highlight, everything is interconnected. You cannot drop one module or one topic saying that, okay, I'm not going to learn this part, I'll skip this, but I can score on the others. No, very rare chance. Everything is interconnected. The concepts we learn in financial markets, that will come to the treasury management or ALM, derivatives, those are interconnected. Regulations apply on these products or the operations in the treasury. So therefore, there are linkages. If you cannot understand one concept in a one module, you may not probably understand another concept in another module perfect. So therefore, please pay attention. Try to know everything. Don't target just 51 just to get the certificate or pass this course. Don't do that. My advice is, keep it in your mind, the target is 100. Keep that target in your mind. You will end up at least somewhere in 60, 70 or 80. But if you work towards 51, definitely you will end up somewhere in 30s, 40s. Because I'm telling this, one thing is clear for me, even though I didn't ask you. One of the objectives, you may have few objectives of attending this class, what you want to achieve. At least one thing is for sure, to pass the exam and get the certificate. That's for sure. So to do that, you have to work a bit hard, change your lifestyle for the next maybe 9-10 months. Be committed. and have a high target. If you achieve that, that's very good, excellent. But even you say for sure, it's not practical for everybody to get 100. Even though we try for that, we will do some mistakes during the exam because of the exam stress and things like that. Maybe last few days for whatever reason you couldn't study. So have that backups for the fallout plans. Don't wait until the exam to study. We never know. That's part of risk management in our day-to-day life. We never know what would happen on the last minute. So don't wait until the last moment. Throughout the period, continuously work on this and try to understand these concepts and revisit the topics that we discussed few weeks, few months back, and refresh your knowledge. As I mentioned, keep a higher target, then you will end up above 50. But if you target just pass mark 51, definitely you won't be able to achieve this. So don't try to select some topics or questions. We will discuss past papers towards the end of the course, 1 or 2 past papers, because just to give the knowledge about the structure of the paper, then you have some idea what sort of questions, what is the structure, then you can prepare for it. But even you prepare for a particular type of question, the question appears in the current paper, you may not be able to answer for some reason. So therefore, when you have to answer 5 questions, sorry, 3 questions out of 5, be ready to answer all 5 questions. Then even for some reason you cannot answer 1 question, then you have 4 questions out of 4 that you can answer. If you target exactly 3 questions, what would happen if something goes wrong that you cannot answer 1 question? So don't do that. And the other thing, even you get this certificate, when you go to work, you cannot say, I have this certificate, but I studied only these topics. I don't know this topic and I cannot. In Treasury, if there are anyone in Treasury, you know, there's no error margin. If you make a mistake, it may be a loss of rupees in maybe millions or billions, not a cent or very small amount. So it's very critical. You have to be accurate. You can't do mistakes in Treasury, especially in banks, however it's the case. But Treasury, when it comes to Treasury, the thing is you have to take the decision very quickly and act quickly, but accurate. You can't, whenever you say something, you cannot reverse it and cancel your transactions. Your word is the agreement. So you have to be very accurate, very quick. So you have to develop that skill. Without that, you cannot work. The other one that I wanted to highlight. So maybe you all thinking about moving into Treasury or working the Treasury. In my view, this course will help officers, those who are not in Treasury as well. Maybe you work in operations or maybe audit, maybe risk management. How do you do audit, conduct an audit on Treasury if you don't know what's happening in Treasury? If you don't know that there are jargons, what does it mean? They will come up with a lot of fancy jargons and confuse you. But if you know these concepts, that will help you to perform your duty appropriately. So, in a good way. So it doesn't matter where you work, whether it's treasury or outside treasury. It can be back office or middle office or the risk management, or maybe audit, or maybe in operations. Still, you may have to deal with treasury people, or you may get direction with from treasury. Or what's happening in the country economy. If you have the correct understanding what is happening in financial markets of the country, you may be able to apply or think about those things and apply to your work, or maybe give some advice to your clients. It will be an advantage for you. So therefore, though the course is treasury and risk management, it doesn't mean that you should work in treasury ultimately. So you may work in some other related or unrelated. Whatever things that you learn in this will definitely helpful for you to take your decision. So that's the end of my first presentation, or just rather the introduction. Thank you very much for listening. So then my famous question, do you have any questions? If you have any questions, please ask. Any questions? Or what does it mean? The introduction, is it full clear, 100% clear? Then you don't have any questions about the course or the modules. Everything is clear.
Yes, sir.
Okay, great. So now someone said yes. It may not be the case for others. If you have any doubt, it's your responsibility to ask your question. No one else will going to ask your question. So if it was a physical classroom, by looking at your faces, I can recognize whether you understood the concept or the message. Now I don't have that opportunity, unfortunately, but we have to live with this. So therefore, it's up to you. Whenever you have a question, come up with and clarify that. So again, I ask whether you have any question. So if you don't have any questions, shall we move straight away to the subject matter? Is it okay? the management is done by the Treasury, and how do you effectively use those things to do what, to get what? Yes, you have to use assets and liabilities effectively to achieve what? Why do you have to manage those effectively?
To maximize the profits and the operational cost, minimize the operational cost.
Yes, try to maximize the profit. Yes, correct. What else? Is there anyone who's working in a treasury now?
Yes, sir.
Yes. How long?
It's been 3 years.
3 years. Okay.
Yeah.
Now, I hope you have one of these qualifications by now.
Currently following my MBA and as well as following CA.
CFA.
CA, Chartered
CA
Accountant.
chart. Okay. So you have to get this as per the regulation.
Yes.
Okay.
Treasury as in, it's a private limited company.
Private limited company.
Yes.
Not in a bank.
Not bank. No.
Oh, then you don't have that requirement.
Yes.
Okay. Who else?
Yeah, I am from commercial bank, Treasury, sir.
Treasury.
Back office.
Okay, good. Then you how long?
It's been 9 months, and I was asked to do that central bank course, and it's on to.
Mm-hmm. Okay. What else? What do you know about Treasury? Others? One thing, yes, mostly because this institution is IBSL, so mostly focus on the banking sector. So the way we have designed this mostly towards the treasury of a bank, but all these concepts can be applied in a treasury of any other corporate or any other financial institution. Only thing is, you may be on the other side of the transaction. That's the thing, but still you manage your assets and liabilities. Not only in a bank, even in other corporate, not only corporate, even in a country, treasury is the heart. So they manage all these financial resources. So therefore, yes, still you can get to know the concepts and how to apply in your day-to-day life. So who is in corporate, if you have any questions, say when I explain things with related to bank, if you think it's not applicable in that way in the corporate, if you have any doubt, please ask. We can discuss that as well, and it will be beneficial for the people in the banking sector as well, how corporate works and how bank works. And definitely there will be a connection, or there will be transactions corporate treasury may carry out with the bank treasury. So there will be a relationship. Corporate may be a client of a bank, so that client agent relationship will be there. So will be beneficial for both parties. Okay. If I ask what is a treasury, as some of you explain, it is the financial center of any organization where you manage your assets and liabilities. You have to make sure your assets are safe. Meantime, you can meet your liabilities. You deploy your assets or your resources in an effective and efficient way. Basically, in this, we mainly focus on the financial resources. How do you allocate your financial resources? To which segment, to which sector, to which period, what is the period that we are going to allocate this money or funds, what is the expected return or the outcome, what would be the contribution to the profit, and doing that, what would be the risk that we take, how do we manage that risk, what are the risks that we should eliminate, what are the risks that we should take, and what are the risks that we should take and what we can take. That's two different. So all those things are mostly done through the treasury, but in a bank or any other corporate or any institution, there will be a hierarchy. In a bank, especially, there will be a ALCO, asset liability committee, where you take some decision from the risk side. There will be a risk committee. They will give some inputs to ALCO. Chief risk officer or someone like that will be sitting in the ALCO, give their views. Treasurer will give his view to the ALCO. ALCO will take a strategic decision. What is the, say, at least medium term, what is the way the bank or the institution should allocate these resources to meet, while meeting the obligations and making assets. Then when it comes to day-to-day operations, that part is done by the treasury. So we will discuss these things in detail later once you have the knowledge on what are the financial products and how financial markets behave. We will discuss those things in detail. How do you manage your liquidity? What is liquidity? How do you manage your assets, liabilities? How do you match those things? If not, what are the risks that will arise? How do you control them? So basically, these are the functions of a treasury: manage assets and liabilities in an effective and efficient way. So that's why it's sort of a part of the organization that will pump blood throughout the organization. Say, if you don't get money in a corporate to do a production, you won't be able to do that production. Whatever the financial support should be given by the treasury. How do you fund that? That's a treasury operations. Whether you issue a bond or borrow from a bank or customers, things like that. So therefore, ultimate quality of the organization will be depend on the treasury. If treasury fails, everything will fail. Even though you have say in a corporate, even though you have a good product, if you cannot produce it to customers because of you don't have funds to buy raw materials and machineries and things, you won't get your finished product, and you may not be able to sell it. So there won't be any income. So therefore, even from bank side, the bank should be able to say you have different loan schemes, facilities to corporates, but whenever a client comes and asks money, if you cannot give it, no point of having a or running a bank. Oh, that would be the end of the bank, your bank. It's not like a corporate. So those things, liquidity and these things will be discussed in detail. However, the key is the treasury plays a major role, or I would say it's the heart of the organization. So as I mentioned, we mainly focus on banks. So therefore, what I'm going to do in this presentation, I'll explain what is the role of a bank. Then to conduct that or to play that role, why do we need a treasury? I'll explain that. Then I'll explain what are the things or the linkages or interactions the treasury make with. I'll give that introduction. So then we'll move into each of these other than clients. Client is one of the things that treasury interact with. We are not going to discuss how to deal with client or manage your clients, but even to manage your clients, to give a service to the client, you may have to use financial products and markets. So we will discuss that side. We will move into that in that way. So that's my target here. First, I'll give maybe a revision for you. What is the role of the bank and why do we need treasury there, and how treasury approach those or conduct those activities. What are the things that treasury needs? Then we'll move into those things and discuss in detail in those areas. Can someone explain me? I hope most of you are working for banks. Yes. Okay. Again, meantime, I will post a questionnaire in that I can get, I have asked those questions. There are those questions you can answer. Then we can see what is the composition of our class participant. However, but just to get an understanding, okay, I think it's easy. Those who are not working in a bank, can you tell that you are not working in a bank? One has already mentioned that she's working for a corporate treasury. Others, is there anyone who's not working in the bank?
Yes, sir.
Yes. Are you working somewhere?
I worked at a finance company, sir, but now I'm not working.
In a finance company? You work for a
Yes.
finance company. Where else? There are 45 participants. Out of that 45, just two, one is in a corporate, one is in a finance company. Others?
I'm working at Bank of Ceylon Corporate.
So sorry, I cannot.
I'm working at Bank of Ceylon Corporate branch.
Bank of Ceylon?
Corporate branch.
Corporate. So however, you work in a bank, you have some knowledge on the banking. No, I'm not referring to treasury. I'm referring to bank. Those who are not working in the bank.
Yeah, we have international division in the branch. doesn't work at the Treasury Department, but
So, someone is trying to say something, but I cannot hear. If you can speak out.
Yeah, we have international department in the several branches.
Sorry?
We have international divisions in the several branches.
International divisions in several branches. So you are for a bank still.
Yeah,
Yeah.
working at the bank corporate branch.
Is there anyone who is not work for a bank? So maybe out of 45, maybe 2-3 who are not working for a bank. So others, you know what is a bank. What other? You might have done some courses in IBSL banking certificate or the diploma, isn't it? So you should be able to explain me what is the function of a bank. Can someone explain?
A bank is a financial intermediary who interconnect deficit units of the market with the surplus units.
Yes, correct. So bank is a financial intermediary which connects surplus units with the deficit units. So what do you mean by deficit unit? What do you mean by surplus?
Deficit means there are institutions may need funds, like you said, for production, for some investment or something. They need funds, and there may be some institutions, they may have excess funds. They might have received extra profits, and likewise through that they have extra funds, so they want to invest. Someone who needs money for their day-to-day activities or some expansion like that. So the need of funds units are the deficit, and who has the excess funds are the surplus units.
Yes, good. So that's the thing. In the society, in an economy, there are people or the institutions or corporates, whatever you say, there are those people or the corporates, they need money, maybe to live their day-to-day life, or maybe to start a business or continue with the business, expand the business. They need, or maybe to build a house or buy a vehicle, whatever the requirement. There are people or the corporate or individuals, whatever you call, they need money. They don't have money, but they require now. We call them deficit units in technical terms. On the other hand, there are individuals. So when I say individuals, it can be a person or a corporate, whatever. So there are individuals, they have more than enough. Say they can buy whatever the things they want, but still they have excess funds, excess money. They don't want to consume it today. They want to keep it for the future consumption. They want to make an investment. So those individuals or those units we call surplus units. So the thing is, if I want to borrow, say, 100,000 rupees, how can I borrow? Can I go to each and everyone that I know asking, can you lend me 100,000 rupees? up to some extent, yeah, maybe within your family or relation or with your friends, you can do up to some extent, but it's not possible all the time, especially when the amount becomes large. Meantime, there may be another person who has excess funds and he wants to lend. Again, he cannot say, I have this much of money, I want to lend this. You can't do that. And the requirement, maybe the one, I want maybe 500,000. The person who has surplus has only 300,000. And I want to borrow for a 5-year period. He wants to lend only for a 1-year period. How can we meet these, bring them together and do a transaction? For that, the bank as an intermediary comes into play. So that takes funds from surplus units and lend those funds to deficit units. So surplus units will give their money to the bank, and empty pocket people or those who need money will go to bank and take out those. But then frequent, whatever the amount mismatches, maturity mismatches, you might have heard the words maturity transformation. So these things will be done by the bank. So there can be borrowings by the bank for different tenors and lending those money into different tenors. You say in a bank, you have saving deposits. What is the maturity? What is the maturity of saving bank, saving deposit? When do you have to pay it back as a bank? What is the maturity of a saving?
As and when customer requested.
Yes, as and when customer requests. So it can be today itself or tomorrow. So it's very short-term funding. But there can be fixed deposits, maybe 6 months, 3 months, 1 year, something like that. But borrowings, for how long? Most of the borrowings from banks are long term, 5 years, 10 years, something like that. So there is a mismatch. We call that maturity mismatch. Banks borrowings are short term and the lending are long term. So therefore bank has to manage that flow. Is it clear?
Yes.
So I hope so, because most of you are bankers and you should know. So when bank does it, what they do, banks charge interest on the borrowings and keep portion of it within the bank and pass the rest to the lender who lends money to the bank. So this is the income or the profit after deducting operational cost and others. That's the income for the bank. So this is the basic function of a bank. Nowadays, the banking business might have changed into different levels, but this is the core banking function. Take deposits and grant loans. So when you do that, you face that problem, amount mismatches and maturity mismatches. So as we discussed, the bank work as a financial intermediary between investors or the depositors, we call them surplus units, and issuers or the borrowers, we call them deficit units. So I just put these words in this slide, so you can prepare this as a note. If you need anything else, you can note it down. Whenever you think I'm not going to read out any notes, I'm just explaining. If you think anything you need or take down as notes, meantime you can take down your own notes. But basic concepts I have put. This is a kind of a mix of a presentation and a handout or the note. So I have mixed both together because the key things will be available in the text forms that you can refer later. Whatever things that you need beyond that, you can note it down. So when the bank does this function, take deposits and loans, bank has to deal with few things. Definitely in the banking industry, we think the transaction is initiated by the customer, not by the bank. Customer comes and say, I want to place a deposit. So the initiation is done by the customer. If I want to borrow, if I want to borrow, then I go to the bank and I initiate the transaction. I make a request, I want to borrow. So both borrowing and lending transactions are originated by the customer. That is another basic concept. Whenever they originate it and the bank gets receive funds and give it as loans, the bank has to coordinate or manage these funds. Because as I mentioned earlier, the amount that you receive and the tenor may not be exactly matched with another customer, those who wants to borrow funds. The amount and the tenor or the period. So there will be a mismatch. So then the bank has to manage that. If you have, say, 1,000 saving accounts worth of, say, 1 billion rupees, there's a one customer who wants 1 billion rupees for a 1 year. Can you take out that 1 billion rupees and grant that loan to the customer who needs 1 billion rupees for a 1 year period? Can you do that? You have 1,000 saving accounts. Altogether, there's a balance of 1 billion. Then there's another customer, one customer, who wants to borrow 1 billion for a 1 year period. Can you grant then that loan? Assuming that you have only that 1,000 saving accounts and only one is customer. Can you do that as a bank?
No, we can't.
You can't. Why?
Since savings deposits are on demand, so anyway, if those customers, 1,000 customers might ask at the same time, or sometimes we have to keep the SRR as central bank requirements. Likewise, we can't use all the money due to that risk, and we have to, if we lend all those things on demand, we have nothing to pay.
Yes, correct, exactly. That's the thing. First thing, forget about that SRR, statutory reserve requirement. We'll discuss that later. Forget about this. Assume there's no such requirement. Still, you don't know. No need to that. You don't know what would happen next day. How many saving account holders come and ask you to pay their money? You don't know. You had 1 billion, you grant it as a loan, then you don't have anything. If customer saving depositors comes and ask that money, no need to be that 1,000 customers come and ask money. Even a one customer comes and asks, say 1,000 rupees only. How can you pay? There's no way unless you can borrow from someone else and settle. That's the but that's the exact thing happen in the banking sector. You generate funds in different ways and grant those or use those funds to generate loans. But these borrowings may be short term, loans may be long term. So what do you do in meantime? Whenever the lenders ask their money, what do? You make another borrowing. You borrow from someone else and pay to that customer. So that's the thing that we discuss or we mentioned, that asset and liability management. That has to be done on the daily basis with a long-term strategy. This is the way that we do our business. That long-term strategy will be established or approved or decided by the ALCO. But day to day, daily, within that strategy, how do you manage that? How do you operate it? Is done by the Treasury. So, what is this liquidity? While you maintain liquidity, you maximize profits. Okay. Before I come into that point, shall we make clear one thing? So now we discuss about assets and liabilities. Now this is a point that you may get confused, especially those who are in corporates and banks. Okay, from a bank perspective, I'm discussing this from a bank perspective. You take a deposit, bank take a deposit. Is it an asset or a liability?
Liability?
It's a liability for the bank because you borrow money, the bank has an obligation to pay that money back. So remember, from bank perspective, deposits that's the deposit saving accounts, whatever you call them, are liabilities. Then what are the assets? What are the assets of a bank?
Loans.
Loans. Whatever the loans that you have granted. But remember, since there's someone from a corporate perspective, the deposit that you place is an asset, and the loan that you have taken is the liability. So please distinguish that difference. Here mainly we focus from the bank perspective. So whenever I call assets, that's mostly the loans and advances or any other investment that you made in government bonds or corporate debentures, those things. But government bonds and debentures, even for a corporate, if they have invested in those will be assets. But deposits are liabilities for a bank. Meantime, for a corporate, the deposits that you place become assets of the corporate. So please distinguish that. Then the other thing is, for a bank, I mentioned this, but I want to highlight that liabilities are mostly maybe 90% or 80%. That's a good thing. If you work for a bank, even not, you can take. Definitely, you will have. You should have access to your balance sheet, at least the published one, and take it and see what is the composition of liabilities. What is the portion of total liabilities are short term and what is the long term portion? Maybe 70-80% in short term. But if you take the asset side, your assets may be 70-80% in the long term. That means maybe 3-4 years or maximum maybe 10 years or 15 years. There are some banks, they give grant loans only up to 10 years. Some banks maybe 15-20 years, depending on their policy. However, most of the assets are long term, most of the liabilities are short. So therefore, definitely there will be a mismatch. You have to pay your customers in the near future, whereas you get money from your investments in the long end. So there will be a mismatch, but there will be cash flows, interest payments or the installment payments that you may be able to use to pay back to the customers. If not, you may have to borrow from someone else and pay that. So can a bank quickly raise deposit? Say you need 1 billion rupees tomorrow, you don't have funds. Can a bank raise that 1 billion through deposits within a day? New deposit. You never know that, because as mentioned here, depositor is the one who initiates the transaction. Unless a depositor comes and places a deposit, you cannot generate that. You can do marketing or apply some strategies to convince depositors to come and place deposits with you, but you cannot do it forcefully. So you don't know whether there will be deposits or not, new deposits or not tomorrow. But you can initiate a borrowing transaction. That means you can go to another bank or another corporate and say, I want to borrow this much. Will you lend me money? So the bank does it. The Treasury, especially the Treasury does it. They initiate transactions. The Treasury initiates transaction in the wholesale market to borrow funds depending on the requirement. And meantime, if the Treasury has excess funds, so whatever the requirement that you need to meet today, you have that funds and more than that. Then what do you do? If you have more funds, what do? Do you keep it in your wallet? especially in a bank when it comes to million and billions excess funds. You don't keep it in your wallets. You try to earn an income, interest income on that money. So then you go out to the market and try to lend your money. That is also done by the Treasury, as because through branches you cannot grant loans if the customers does not want to take a loan. But in the market, there can be another bank who needs money, or there can be another financial institution who needs money, especially banks who needs money. Then the one bank can place a deposit or grant a loan to another bank for a short period. That sort of things are done by the Treasury. When you have a deficit condition, try to fund that deficit. When you have surplus, try to invest that fund and maximize your profit. So then I'll come to this liquidity, because that's the operation that we call, it's called liquidity management. What does it mean by liquidity? What does it mean by liquidity? Have you ever heard this word, liquidity?
Ability to settle the debts on demand.
Yes. In this context, we will discuss about liquidity in different aspects. But here, what do we mean by liquidity? As an individual or an institution, the ability to meet its obligation. So if I have to pay a debt today, I should be able to pay it. For a bank, it's not only debt. You have granted a loan to a customer, and customer comes and asks that money. You should be able to disburse that as a bank. Depositors, they will come and ask their money. You should be able to pay it. You might have borrowed funds from another bank, and now you have to pay that. So that ability is we call, so maintaining that ability is we call liquidity management. What is the amount of funds that you have to meet your requirement, obligations on time? It's not that the obligation falls due today, you pay it tomorrow. It's not the case. If a customer comes and asks money today, if you say, sorry, we don't have cash today, can you come back tomorrow, as a bank, what would happen? Can someone imagine what would happen if that happens? Next minute, there will be long queues in front of the bank. Everybody will come and ask their money. So you never turn down or a customer or refuse to pay his money. That will be the end of the bank, or maybe several banks. That will have ripple effects to other banks as well. Because as I discussed at the very first, you have 1 billion savings, or maybe you keep 500 million in cash form, but you have give a loan up to another 500 million. If all these 1,000 customers comes and ask money, can you pay? No. none of the banks, whatever the best bank in the country or whatever the best bank in the world, if all depositors and all lenders, whoever who has the claim against that bank, if everybody comes and asks that money at the same time, there's no way that you can meet that. The assumption here is that different people have different requirements. So it's a sort of a random, not 100% customers comes and asks there. Even you said saving account is a sort on demand. Not everybody get money frequently. Even in saving accounts, there are people, they keep up without touching. You have very recent experience, no, in the news. So even the salary you don't touch, you keep it in the saving account. So that can happen. So based on that assumptions only, banks perform or conduct this business. But bank has to take a calculated risk. They should have forecast, okay, what is the proportion of saving accounts, the customers, and the amount would come and ask, oh, what are the given exact liabilities? Then what would be our funding requirement for today, tomorrow, and for this month, this week? That has to be planned and forecast. Then try to meet that or maintain that funding requirement. We call that liquidity management. That is done by the Treasury with the help of other units of the bank. Depending on the bank structure, there can be different divisions or the departments, whatever you call operations. You might have different units for deposit tracing and another unit for lending activities. Again, that can be divided into different parts for corporates and for individuals and things like that, or small and medium enterprises likewise. So you might work in these areas in silo basis, but ultimately everything will be reflected in the books in the Treasury. Treasury people, they see the overall or the macro picture. What is the situation of the bank? If they think they don't have enough funds, they should take some steps to generate funds. If it is very short term, they can act on that. But if that funding requirement is long term, then the ALCO and the other respective committees and the divisions have to deploy another technology, maybe to promote deposits or maybe to promote loans, whatever it is. That will take care of separately from outside from the Treasury, but Treasury will give some input into that as well. But in very short term, day to day, liquidity management, we call it liquidity management, generating funds that is enough to meet obligations of the bank is done by the Treasury. So that's the core activity of Treasury. Before I move into this slide, any question? Or other thing, any comment? Am I very slow or very fast, or is it clear? If you need any adjustment, please tell me. Don't wait until the end of the course and says it would have better if you did it that way or this way. It's too late. If you have anything, any comment, please make it now at the very beginning, maybe within first few classes. Okay, any questions or any comments? Is it clear what I explained, or is it something that you already knew, or it's a waste of time? No response.
Clear, sir.
So no questions. Shall I move
Sir,
forward? Yes.
sir, I have a question. What do you mean by ALCO
Asset Liability Committee, Management Committee. Asset Liability Management Committee.
committee? Okay, thank you, sir.
Sorry. Anything else? So if not, we'll move. So as I mentioned, Treasury has to maintain the liquidity and make sure that the bank meets its financial obligations. Meantime, the bank earns profit. The thing is, okay, let me ask a question now. As the bank, so as I mentioned in the previous example, you have 1,000 saving deposits with 1 billion rupees. Now there's a risk that they will come and ask their money. What do? Do you just keep it in your wallet? Because they will come and ask their money at any time. So we should be able to pay. Will you do that? If you keep that cash in cash form in your wallet, yes, your liquidity requirement is fulfilled. What does it mean by liquidity requirement? You can meet your obligation anytime. There are 1 billion worth of deposits and 1 billion worth of cash. The deposits is the liability, cash is the asset. So it's the cash form. You can pay whatever the amount customers or the depositors ask, you can pay. Can you do that? Or will you do that?
No, sir, we won't do.
Why?
Because keeping funds means it's a cost. So we will invest somewhere else and calculate in the required risk. And we will try to invest it for short term or maybe long term, depending on the our forecast on the customer's requirement.
Yes, exactly. If you keep that funds idle in cash form in your wallets, you won't earn anything. You don't get any interest income. You don't get any return. But customers, you may have to pay interest as well. Assume there's no interest payment required, but still you won't want anything if you keep it in the cash form. So therefore, keeping everything in the most liquid form, that means the way that you can meet obligation, it won't help you. Then as he mentioned, you have to segregate or bucket these into or group it into different maturity periods. You may invest out of that 10-20% maybe in the place where you can invest today and get that money back tomorrow. We call that overnight, just for a 1 day. Then next day you have that cash flow. You can meet your liquidity requirement. Part of it you may lend it for 10-20 years. Another maybe into 1 year, 2 year, 3 year. So across the spectrum, you distribute it and make investments. Otherwise, you may not be able to maximize profit. You will maintain liquidity, but you may not be able to maximize profit. So there's a trade-off. When you try to maintain your liquidity, that means ability to meet your obligations, you forego your profit. When you try to increase your profit, you give up your ability to meet your requirements or the obligations. So liquidity and profits move in opposite side. When you try to increase your liquidity, your profit may go down. When you try to increase profit, your liquidity may go down. So there's a trade-off between these two. So therefore, the function of a treasury is to try to strike a balance between two and get the optimal profit. So rather saying maximize, it would be the optimal. To the risk that you take, what is the maximum return that you get? That's the optimal return that you can get. To do that, treasury has to deal with few things. First thing, clients. The treasury may have to raise funds through clients and invest through clients. But the set of clients that treasury deals may be different from the clients that handled by the other departments or the other divisions of the bank. Treasury mostly deal in the wholesale market. They don't take 100,000, 200,000 deposit. They don't grant 100,000, 200,000 loans, the treasury. But maybe in millions or even maybe 100 million or something like that, even a 1 million, 5 million may not go through a treasury. That may be the retail. So the treasury deals with or the contract have contacts with clients, the wholesale clients. That can be individuals or maybe corporates or other financial institutions, including banks and the central bank. So that's one thing. The other thing is the treasury deals with financial markets because they raise funds through financial markets. They lend money through financial markets. So the treasury has to deal with clients and financial markets. How do you deal in the financial markets? What are the tools that you have? Those are the financial instruments or the financial products available in the market. There can be different types of, there are different types of financial products cater to different or various requirements. So treasury will deal with financial markets through these financial instruments. So you can see here shares or equity, bonds, then the indices like share price index or bond market indices or whatever. Then the forex market, foreign exchange market, commodity price markets, and the derivative markets. These are the sort of broad categorization of financial instruments in these sectors. Again, within shares, there can be categories. Even within bonds, that can be there can be different classification depending on who is the issuer of the bond, what is the requirement, in which market they issue the bond, in which currency, and the nature of the interest payments. Based on that, there can be different features. So we'll discuss these. So basically what I wanted to highlight, the Treasury deals with clients, markets, and products in order to meet whatever the things that we discuss. The first thing, provide funds to meet the bank's obligations to deposit. The bank should be able to meet depositors' obligation. Whenever depositor asks money, the bank should be able to pay that. And for the borrowers, whenever they borrow and they want to withdraw money, the bank should be able to give that. Not only that, now the current environment, there can be borrowers. They will come to a bank and ask or say that we need to borrow this much amount of money, maybe 10 billion rupees. Then now the current trend is the bank is not going to lend $10 billion to that corporate. The bank will try to help that corporate to borrow funds through other investors. The bank will form a deal or a product and sell it. Then ultimately, investors will lend to the corporate. The bank just do the facilitation part and take a commission and go out. The bank does not take any risk thereafter. So that's the current trend, or nowadays it's happening mostly. So we call that investment banking. So some of the banks, they do just only the investment banking, not the commercial banking. So through that, the Treasury tries to reduce the assets on the bank balance sheet and give some alternative ways for the customers to lend and borrow funds. The bank gets a margin and walk away without taking a risk. Then the balance sheet won't expand. The risk would be minimized, but make profit. Then bank will try to trade or do transactions on these products. One investor wants to sell his bond holding or the shares. Then the bank will buy it and sell it to another person. Again, keep the difference. So trading, that's another part of Treasury. There's an importer who needs dollars. There's another exporter who has dollars, wants to sell it. The bank will buy from the exporter and sell it to the importer, but at two different rates. The difference is the profit. There's no expansion or no addition to the balance sheet. Just facilitating the transaction, but make money. And the other thing is now banks are mostly focused, not the interest income. Their focus is on the fee. They provide services to customers and charge a fee. And then with less risk, they maximize their profit. So however they do that, by or with the interaction with clients through financial markets and through financial products. So that's why before we discuss about in detail what are the functions of a treasury, what is the structure, why do we need that structure, things like that, first we have to have a good understanding on the financial market, different financial markets available, and what are the financial products available in the market, and when to use these products. Not that each and every product that you can use all the time. Depending on the features of the product and the requirement, you use different products. So therefore, first we have to have a good understanding about financial markets and these products, then to use them in treasury to achieve treasury objectives like this. You borrow funds as a bank from customers, you have to pay interest. You lend funds to customers, you earn interest. That difference is the interest income. You pay less interest to the depositors, you charge high interest from the borrowers. The difference is your interest income. But in the financial markets, interest rate may go up and down time to time. If you follow up the market, what has happened last week in Sri Lanka with regard to interest rate, what is the development, latest development? And someone,
AWPLR has gone up.
sorry,
AWPLR has gone up.
AWPLR has gone up. Why?
Because of the inflation.
It's because of inflation. Yes, when the inflation is high, interest rate goes up. True, but not. It's not just because even the inflation goes up in the markets. Yes, interest rate can go up, but there's a key event happened last week.
Foreign currency issue.
No, that is also there. But when the depending on the interest rate level of the interest rate, they will have that will have an impact on foreign currencies flows and inflows and outflows. We'll discuss that as well. As I mentioned, yes, all those things are linked together. It's not the key event. There was someone who worked for a treasury, even in a corporate. You should pay attention to this. What's the key event happen?
Government had to pay some loan installments.
All those things were there. It's not the key.
Because policy rates increased.
That's the thing. Yes. Policy rates increased by the central bank. So, do you know what is policy rate? Have you ever heard about it? What is policy rate? If not, don't worry. I'm not going to discuss it now. We will discuss those things in the future. What is policy rate? Who is changing that policy rate? It's the central bank. Then what would happen to the market? Why the central bank would change the policy rate, increase or decrease? Why? Then how do you anticipate that? In the financial market, it's not after the fact. Once the interest rate increase, everything is, or everybody knows that interest rate has increased or interest rate has decreased. But before that, you have to anticipate it and take some action depending on your forecasts. So those are the things. If you follow this course, or not even you are not following this course, as bankers, whatever the job that you do there, better to have some understanding what's happening in the markets. So markets and the economy. Again, these two also interrelated, market and economy. So to perform the economy, you need market. Economic activities will help the market to boost as well. So again, economy and the financial markets go in tandem. So what I wanted to highlight, pay attention to the news, especially with regard to economy and financial markets. What are the announcements made by the central bank, government with regard to taxes or new policies, or even the government announces few weeks back 5,000 salary increment. As a treasurer or as a person who works in treasury, do you have to pay any attention to that news? Is there any implication? What do you think? As a person who works for a bank and especially in a treasury, it's not just an isolated or just a salary increment for the government sector, and you worry about, so, okay, they got 5,000 rupees, we don't get. No, you can earn more than that if you get that the implication of that properly and perform your duty or place your transactions or the strategy based on that. You will get a bonus more than that, maybe 10 times or 100 times of that if you read it properly. So don't consider these things are not relevant. All these are relevant in the financial markets. So read those things, try to evaluate, incorporate, or think in terms of the theories that we are discussing here, and come up with a scenario. Okay, if this event happens, this would be the outcome. This would be the risk to us, or this would be the opportunity for us. You need to have that. So that's it. I have to mention. Okay, sorry. To finish this treasury objectives. So interest rate exposure, treasury has to manage that. Interest rate changes, so that will have a different impact on your assets and a different impact on your liabilities. As I mentioned, liabilities are short term. When interest rate goes up, your new liabilities will be at a higher rate, but still the long term assets will generate at the historical interest rate if you have fixed the interest rate for the lifetime of the product. So your interest income margin may narrow, or it may be at a loss now. So the treasury has to take some action to overcome that. Then the foreign currency. As I mentioned, exporters will sell foreign currency, importers will buy foreign currency. Meantime, you will accumulate some foreign currency depending on your view what would happen to foreign currency, whether rupee appreciate or depreciate. Then how do you manage that exposure? Meantime, you have to maintain relationship with other banks, because you may have to borrow from them, you may have to lend to them. So therefore, you have to maintain that relationship, have the understanding, make the relationship, and share your thoughts and develop that. Then cash and working capital management, sort of liquidity management. What is the amount of cash that you required for what? So to do that, you have to have a good forecast in cash flows daily, maybe for a 1 week or 2 week, 1 month daily, then monthly or weekly, quarterly, whatever the way. You should have a good forecast on the cash flows, and there are requirements on the liquidity imposed by regulators. Liquidity requirement, you have to meet those, the controls and authorities and compliance. Meanwhile, you have to report to the management. Okay, this is the position of our bank. Give reports to the ALCO or the risk committee or to the board, explaining what is the position, what are the risks, what would be the profit, things like that. All these things has to be done by the Treasury in compliance with the regulations and guidelines issued by the central bank or any other regulatory authority, and while working within the controls and authorities imposed in the Treasury. Not the Treasury people can do anything. There are controls. There will be limits. What are the products that you can trade? What is the tenor that you can? What is the amount that you can transaction? Who can do what? All those things will be there. Within all these controls and authorities, the Treasury should be able to perform these duties in order to ultimately meet the liquidity requirement while earning an optimum profit. That is the basic function of Treasury. And as I said, when Treasury conducts these operations, the Treasury has to interact with financial markets and trade financial products in the financial market. So therefore, the next presentation will start to discuss financial markets. Within that, we'll discuss the financial products and the related concepts for maybe next basic introduction on the financial markets, maybe today, the next presentation, and maybe next week. Then beyond that, we'll discuss about other products in the first maybe at least 1 month or within 2 months, we have to discuss those things. So that's it about this presentation. Any questions? Any questions?
So what made central bank to decide on policy changes?
I think you are referring to the interest
rates. Yes, sir.
Yeah. So if you visit the central bank, there are two objectives. One is the price stability. The second one is the financial system stability. What does it mean by price stability? Keep the price levels at a steady level, not let it to increase. That means keep the inflation intact. So now the central bank sees inflation is going up. The way to control that is to increase the interest rate. That's the basic behind that decision. There can be other things, what is happening in the exchange rate or the foreign exchange market, that also might have factored into that. But basically, interest rate changes depending on the inflation and the economic growth.
Thank you, sir.
Anything else? So, as I mentioned, or ask you, don't hesitate to ask questions. whatever the question you have, please ask. That will help you to improve your knowledge. The one thing is, say, one example. So I cannot remember whether I explained that word. I just mentioned the word ALCO, the abbreviation. So it's my fault, that's true. But if you don't understand, you should ask that. If you don't know, there can be things like that. One way I may forget to explain that, or other way I might think, okay, this is a very basic thing that you should know that already, and I might not try to explain that. But it's not the case for you. Then better you ask that question and clarify it. If you don't know that, ask that question. It may help others as well, even though they are also silent, maintain silence. Still, they don't know that can happen. We say, if I say now someone asks the question, why the central bank increase the interest rate or the changes the policy rate. If I ask the same question from you, how many of you could have answered that question? There may be someone who can answer that question, but maybe majority may not know the answer. So now with that question, even others, they get to know what is this reason, isn't it? So better ask questions, especially related questions. Don't ask which is not relevant. If you think it's relevant, you can ask. That's true. That's correct. That's okay. Ask questions and try to enhance your knowledge through that. Or if you think by asking question you want to test me, again, that can be done. If I know the answer, I'll give you the answer. If not, I'll tell. So I don't know. I am not in a position to answer that question. So that's another thing. There can be some questions which I am not in a position to answer. If it is the case, I will tell that. And and again, I think there's a disclaimer in this as well. Yes. So these are my personal opinions, not the central bank or the IBSL or any other institution opinions. Whatever I tell you. So please note that as well. Okay. Any questions or any comment? The usual way, what we do, we start 8:30 and we'll take around 15 minutes break around 10:30. Now, because today we could do that again, as I mentioned, depending on the flow. So now I didn't want to stop with the 1 or 2 slides remaining at 10:30. So that's why I continue. But we can take a break now. So we'll make it today 10 minutes and we'll start by 11 o'clock. Is it okay? So I'll play a small video for you. Hope you can see this. Can you see it?
Yes, sir.
Yeah, okay. This is about a brief introduction about ALM and Treasury, what I mentioned. So just watch it.
The ever-expanding variety of products offered to customers of financial institutions has made the banking business relatively complex and created risks that need to be managed. A key part of risk management is the efficient asset liability management function that identifies profitable opportunities with a balanced division of risk and reward. The term bank is assigned to a number of very different institutions, including commercial banks, which give loans to customers and hope to earn a return between the cost of funds borrowed and cost of funds lent out. Investment banks, which earn fees for their services and act as agent in activities such as the mergers and acquisitions. Trading banks, which operate in a number of trading markets, such as a foreign exchange trading desk. Each business line generates different risks, including interest rate risk, that is, the interest rates on assets and liabilities that are subject to change over time and can result in interest income becoming negative. Further, there may be opportunity costs in terms of interest foregone, because newer loans could be made at more favorable interest rates. Liquidity risk, that is, it may not be possible to raise new funds to cover the maturing funds at a reasonable rate. Credit risk, that is, the risk that a counterparty is unable to repay borrowings, and other risks, such as changes in equity values affecting the viability of an equity trading operation. For the commercial and trading banks, risks are not generated as a byproduct of the business, they are the business. In this sense, the banks can be seen as risk factories. The asset liability management function focuses on interest rate and liquidity risk. The function is so called because it manages the risks of mismatches between assets and liabilities. Matching a 5-year fixed-rate loan against a 5-year fixed-rate liability, such as a fixed-rate bond issue, would result in little liquidity or interest rate risk. But in practice, the stated maturities of assets and liabilities differ within a portfolio. For example, banks might raise funds through customer deposits into checking accounts which have no term. On lending this money to borrowers exposes banks to liquidity risk. The most obvious risk not managed through the asset liability management function is credit risk, as this monitoring and management process is predicated on an assumption of zero default risk. Even without default risk, if a bank's assets and liabilities are mismanaged, the outcome can often be fatal for an institution, as shown by the experience of many banking organizations during the financial crisis. Northern Rock was one such organization that specialized in residential mortgage loans, borrowing funds on a short-term basis while lending the funds for long periods. As interest rates became volatile from 2007 onwards, short-term rates increased sharply. Banks like Northern Rock were unable to roll over their short-term funding. As economic conditions worsened, depositors started to withdraw their funds, further exacerbating the pressure on bank balance sheets. Unable to cover their funding requirements, banks applied to central banks for funding to help with the liquidity crisis. While some banks were rescued by the central bank or merged with other banks, others were effectively closed down. The financial crisis was perhaps an extreme example of how a volatile interest rate environment and an uncontrolled mismatch between short-term borrowings and long-term loans undermined the banking industry. It is in this context that this...
So, is that brief what we discussed so far, other than that credit risk part that I didn't touch. So, but it explains, assuming that there's no credit risk, how the ALM function and the Treasury manages, and it discuss the different types of banks, commercial banking, investment banking, and trading banking. But in Sri Lankan context, maybe the same banks conduct all three with or without that segregation. Maybe different units within the same bank conducts all these different activities. Then the importance of liquidity management, that means ability to meet the obligations. So this is just to be more clear on that. So with that, or is there any question before we move into the next presentation? If you have any questions, please feel free to ask. Any questions? Any questions, please?
I need to ask one question. Am I
Yes,
audible?
go ahead, but it's not very clear.
Now, am I audible?
Yes.
Like one question, according to the recent central bank policy rate changes, we can see SDFR and SLFR both rates.
Sorry. With the policy changes, then the next part.
Interest rate changes.
Yes.
SDFR and SLFR, standing deposit facility rate and standing lending facility rate. Between these two rates, we can see there's only one percent margin, 5.5 and 6.5. I just want to ask whether the central bank needs to give flat rate to keep margin against lending to banks.
No, I didn't get the last part.
I just want to know.
So you refer this SDFR and SLFR 5.5 and 6.5. There's a 1% margin. Yes, that was clear. Then with regard to that,
what I want to know is the central bank, is there any requirement to keep flat rate to make profit out of that deposits against lending? Now we can see there's only 1% margin.
So is it a profit margin for the central bank? No, it's not a profit margin. Yeah, indeed, it makes a profit through this, but the purpose is not to make profit for the central bank. Central bank is not a profit oriented institution. So this is just to maintain the market interest rate. Why there are two different rates? Because even in the market there should be two different rates. Okay, I'll explain this. What would happen now? Say you have excess funds. Say you have excess funds. At what rate will you lend? Minimum rate that you lend. What would be the minimum rate that you charge if you have excess funds and you can lend overnight? What is the minimum rate that you would charge?
Deposit rate.
Sorry?
A deposit rate.
The 5.5.
Yeah.
Why? At the end of the day, if you have excess funds, you can come to the central bank and park your money at the central bank at 5.5% per annum, but for a 1-day deposit. Then when you have that opportunity, you won't lend money below 5.5. Correct? Is it correct? Hello?
Sir, can you explain it again?
Yes. So the central bank is there for a bank to lend money at 5.5. The bank, any bank can come to the central bank, commercial banks can come to the central bank and say, I have this much of money, I want to lend it to the central bank at 5.5, not less than that, or not more than that. So the minimum rate that you can get is 5.5.
Yeah.
Oh, say not the minimum. You have the opportunity to lend at 5.5 to the central bank.
Yeah.
Will you lend that money to someone else below 5.5? No. So then this will set a flow in the market to the lending. Is it clear? Nobody in the market would lend below 5.5. Correct?
It means we can't go below that level, no?
No, you want, you can if you wish, but will you go there?
No.
As a rational person or a rational institute, you won't go below, because whenever you have the opportunity to lend to central bank at 5.5, you won't lend it to someone else taking the risk as well below 5.5. So in the market, minimum lending rate would be 5.5. Clear?
Yes.
Okay. Now think about, you are in a deficit. You want to borrow.
Okay.
What is the maximum rate that you willing to pay?
6.5.
6.5. Because you can come to the central bank and borrow from the central bank at 6.5. You are not going to borrow from anyone else paying more than that. Correct?
Yes.
So then, but when it comes to a transaction, the lending and borrowing is the two sides of the same transaction.
Yeah.
Then the borrower and the lender has to come to an agreement to a rate. Isn't it?
Yes.
So the lending rate and the borrowing rate would be the same, just one rate. So with this bands, 5.5 and 6.5 band, what would be the market interest rate? It would be somewhere in between 5.0 and 6.5. If there are a lot of funds available in the market, the interest rate will be somewhere closer to 5.5, because there are enough funds in the market, but less demand. Then you lend it at a lower rate because you want to lend. But when there's not enough or sufficient funds in the market, there will be high demand but less supply. Then the interest rate will be close to somewhere 6.5, but not beyond. That's how the central bank maintains the interest rate in the market. with that objective, this band is given. If you fix one rate, then each and every transaction has to be done at that rate. It's not possible. Then there's no market, or there's no room for the market force to play. Is it clear?
Yes. It means these rates will be act as a
as a band and to the guide to the market. If there's someone who is not willing to borrow from the or no ability to borrow from the market, worst case they can come to the central bank and borrow at 6.5. On the other hand, if there's someone who is not willing to lend at the market, other participants in the market, to take that risk, they can come to the central bank and lend that money at the lowest rate, 5.5. Otherwise, the transaction will take place in between that 5.5 and 6.5.
Yeah.
Clear?
It means it's like a benchmark rate, right?
Yes, yes. This is the policy rate benchmark.
Right. By doing so, what is the direct impact to the economy?
So now this will be considered as the, as you mentioned, benchmark rate in the market. This is overnight. That means for a one day to the central bank. Then in the interbank markets, among banks, there will be borrowing and lending. All these will happen at that in between somewhere, this 5.5 and 6.5. Then depending on the risk and the maturity. So this is, as I mentioned, for a one night, overnight, or the one day lending. If you want to lend it to a 7-day, you will add a premium to that. If you want to lend it for a 1 year period, then you will add another separate premium for that. We will discuss that when it comes to the discussion on the interest rate. And depending on the party, if you lend to the government, what is the risk premium that you add? If you lend to a corporate, what's the risk premium that you add? If you lend to an individual, what is the risk premium? Because the risk of the borrowers are different. So then your risk required rate of return to take that risk is different. But everything will be based on that overnight rate. That will guide the interest rates in the market.
I think you
then what happened? Your question is what would be the impact to the economy? So now earlier, what was the rate?
Deposit rate.
No, this policy rates.
5 and 6. Yes.
Okay, 5 and 6. Now assume 5 and 6. Now 5.5 and 6.5. Now the interest rate has increased. Compared to the previous interest rates, what do you expect now?
Control circulation.
Sorry, control?
To control circulation.
Speculation.
No, circulation. Money circulation.
Money circulation. Why?
When the central bank is trying to increase especially the deposit rate, people will try to keep money in their savings account.
They will try to keep their money in saving account when the interest rate is high. That's what you are telling. Okay.
Yeah.
If as individual, they will try to keep it in the savings account. If not, what would they say when the interest rates are low?
Then they will try to invest somewhere else.
When the interest rates are low, they will try to invest.
Share market or any other business.
Individuals.
Yeah, especially individuals, share market or anything else.
Yeah, in a way, yes. So especially in the if we consider individuals, I'd say if you have a lot of funds, yes, it works two ways. One thing is correct what you said. When the interest rate's low,
They will buy properties.
yeah, that's one thing. Okay, yes, true. No, when the interest rate is low, two things can happen. That will promote investments. That means even a corporate, they can borrow or generate funds at a cheaper rate and make the investments, and with a profit margin, they can make a profit. So investment, that sort of investments will encourage. On the other hand, as someone mentioned, people may try to buy properties, land or houses, or at least construct. So what would happen? Economic activities stimulate, more activity. On the other side, you have money, you don't earn that much of interest income. What do? As the person who has surplus money, what do?
If I want, I can invest somewhere else. So,
If you can invest in share market or something like that, yes, that will do. That's why when the interest rates are low, share markets are performing relatively well, because investors will buy the shares, and even the corporates, they can borrow funds at a cheaper rate and continue their business and increasing and assume that they can earn high return in the future. But as individuals, what do when the interest rates are low?
we are not trying to keep our money in savings account.
You don't try to keep money in your savings account. So those savings we collect, and banks or other institutions that collect savings and lend to corporates. That's what happened.
Yeah.
What would happen when the interest rates low? People won't tend to save that money. What do they do instead? They will consume. That's what happens. When the interest rates are low, people will tend to consume. That will create demand. And if the supply is not there, that will create inflation as well. But that's why when the inflation going up, interest rate increases. Even for the firms, when they have cheap funds, what do? They borrow and they try to do some more production, expand their plants and things. Then that also creates a demand for the capital goods. So I mean, a capital demand on the capital goods, it's okay, because that will generate future production. But on the other side, when it comes to consumption, without a production, if the consumption increases, because for that investment, it takes time to expand the business and come up new products for even the same product, high volumes, but the consumption comes very quickly. Then the inflation will go up. When the interest rate increases, people will tend to switch from consumption to savings. That savings again can be used to investments in the corporate, but then corporate has to pay high interest cost. Then in that sense, the investment will come. That's why we need to have a balance there, depending on the economic activities and the level of inflation and other macroeconomic factors. So if you want to stimulate the economy, lot of economic events to happen, then it's better to keep the interest rate low. When it's heat up, inflation goes up, then interest rate set it at a higher rate. Is it clear?
Yes, like Japan, right?
Sorry?
Like Japan.
In Japan situation is
they are not paying any interest for the
yes,
deposits.
It's in the I think you say worst case or extreme.
Yeah.
They keep the interest rates at low, but still there's no consumption. There's no growth in consumption. People still tend to save. So therefore no inflation. So there's no that will have an impact on the growth. There won't be economic growth. That's the concern. Not in that Japan also, even some in the Europe and US. In Europe they have negative interest rates, not zero, negative interest rates. So still they try to come up with that. In economic, there's a theory called liquidity trap. Whatever the interest rate that you bring it to low, individuals or people tend to save without consuming. So that is called liquidity trap. In Japan, we see that kind of situation. The concept is everywhere approved for whatever the country, even US. That's why they lowered interest rate with the global financial crisis. Then with this pandemic, whenever they see crisis, to stimulate the economy, any country, central bank will reduce the interest rates. Then when they see the economic activities are picking up and it's too much, inflation is rising at a faster rate than required and going beyond the target level, then they will try to increase the interest rate and curb that, control the inflation and the economic activities. You say it's like a train or a whatever. There's a speed that you can go. To go from one place to another place, you need a speed. You have to go, but if you go too slow, that will delay. If you go too fast, that will create other disasters. So there's a you have to maintain a steady pace, speed to achieve that. So the objective is to achieve that steady or the appropriate speed. You can't have inflation at zero and not at even at maybe at this 14% or 20%. Depending on the economy size and the other environment, there could be a appropriate level that you have to maintain. That say if you take US, they have a target of 2% inflation. They want to anchor it, try to maintain inflation around 2%. If it is going above, they will increase interest rate. If it's going below that 2% target, they'll reduce the interest rates. Anything else?
Okay, thank you.
So that's what I told you at the beginning. This is a sort of mix of finance and economics. You need knowledge on both when you are in the market. You should be able to understand these things. Okay, what would happen when the interest rate increase to the exchange rate? There's a link in that as well. Again, it's the sort of economic theory. when the interest rate increases, if the capital flow is free, foreign investors will come to that high interest rate country and invest there because they can earn a high rate of return compared to their low interest. Say Japan, their interest rate is 0. In Sri Lanka, if they can get 5%, it's a big margin for them. Then they assess whether to the risk of taking the Sri Lanka risk, whether that 5% is enough. If they think it's enough, they will come and invest. It's not only the interest rate is factors or matters, other factors matters as well. What are the opportunities? What is the legal framework? What are the infrastructure? These things matters, but that's how it works. So when the interest rate goes up, we should expect foreign investments to come in. Then when the foreign investment comes, when foreign currency flow is there, exchange rate should, in Sri Lankan context, exchange rate should go down. That means rupee should appreciate. So all these things are linked to each other. You can see that now. Anything else, or did I answer your question?
Yes. Yes, sir. Thank you.
Anything else? Okay, then shall we start this? So this is the outline. I'm not going to go through this. I hope you got the detailed syllabus. In that, we have described what are the objectives and what do we expect from you each and every topic. In some of the presentations, I have included that, but in some I might not. But you can refer that document and target those. Say in this, you should be able to explain the role of the financial market. You should be able to describe different types of financial market. So these are keywords. So at the end, you will be tested on these things. So I'll skip these objectives and straight away come to this introduction to the financial market. Forget about financial word. What is a market? What is a market?
Place for buy and sell goods or services.
Yeah. Generally, we refer it as a place for buyers and sellers to exchange their goods or services. So, but even though we say it's place, it not necessarily nowadays be a physical location. So, have you been into a market like this? Probably yes. Even you go to a supermarket, it's a market where you buy your things and the sellers sell their goods and services. So markets basically where buyers and sellers mix. What is this? And this are these markets. Can you recognize this? This one. And this one. These are also markets. Online, in one, this one, Alibaba. That's a place for the buyers and sellers to buy and sell their goods. What is this? App Store. You get your software, again services, but virtual thing. So that's a market. Need not to be a physical location. There should be nowadays that physical locations are getting disappear. Most of the things become online or virtual platforms. So, but still they are markets. But then what is a financial market? So I think now I have explained this. Generally a market, a place or an instrument, whatever, or a mechanism. So these two we can consider as mechanisms to bring buyers and sellers together to buy and sell their goods or services. So as I mentioned, need not to have a physical location and can deal any variety of goods and services. Nowadays there are many different ways of doing that. Need not to have a physical location and meet them physically. Then what is a financial market? Again, the same concept is applicable where buyers and sellers trade their or exchange their services, goods and services. But here, what are the goods or what are the services? In the financial market, we trade financial instruments. The same set of financial instruments I showed in the previous presentation. It may be shares or stocks, bonds, commodities, derivatives, all those things. Yeah, agricultural products, agricultural goods. All these things can be traded in a financial market. Then you may wonder, why do we say commodities and agricultural goods comes under financial markets? That again depends. So even based on this specific commodity or the agricultural good, there are financial products that trade on that. So derivative products and even commodities like gold or oil, they are with huge values, and they are also trading through traders. They make money indeed. They may not exchange that commodity. They don't exchange gold or they don't exchange oil, but they make money out of that commodities. The underlying transaction or the underlying asset is the commodity or the agricultural product, but the transaction takes place or the instrument is financial. That's why even the commodities and agricultural other commodities, when you say commodity, maybe precious metals, energy, including gas or agricultural goods, comes under this. Not only that, if you go deep in this, even weather is traded in the financial markets. What would be the rainfall? What would be the snowfall? What would be the temperature? These things also, or the wind speed, these things are traded in the financial market. So you convert that into a financial or the monetary value and trade it. So that's why in the financial market, commodities are also included. But basically, in general, we say in a financial market, buyers and sellers trade their financial instruments and products. So again, finance you can consider it as a service, but there are products. So in the markets, this is linked back to again the what we discussed about banks. There are savers and borrowers, depositories, governments and companies. So don't forget that government in many of the countries, government is the biggest borrower than the companies. So that can happen. There are exceptions as well. There are governments, they don't borrow. No need to borrow. They have enough income. But even with enough income, still they may borrow just to maintain the market and maintain the interest rate structures. That can happen. However, borrowers are basically mostly companies and governments in the large scale wholesale market, and there are savers. So then the banks comes, as we discussed in the morning. Bank takes deposit from savers and grant loans or overdrafts to companies or governments. That was the traditional banking module. But in the financial markets, through share market and bond markets, we'll discuss what is share market, what is bond market in detail later. Through these markets, with the help of a bank or an investment bank or intermediary, savers and borrowers enter into transactions directly. So what is the difference? You should understand, when it goes through banks, bank has the obligation again towards the savers. Borrowers has the obligation towards the banks. If I go back here, so two different transactions. Savers has an asset or a claim against banks. Banks have the obligation towards savers or the depositors. Then that's a one transaction. On the other side, bank has a claim against the company or a government. Government has the obligation, or the company or whoever the borrower has the obligation towards the banks. That's it. So two different transactions. If one of the companies fails to pay its obligation to the bank, it should not prevent the obligation which has bank towards the customer or the depositor or the saver. The bank still obliged to pay the depositor, saver. Is it clear? Is it clear?
Yes, sir.
Yeah. Then, but in this could happen, savers will directly invest in companies through share market. Then they take the risk of the company. If the company fails, savers or the depositors will lose. The bond market also same. If you buy a corporate bond, if the corporate fails or defaulted, then saver will lose. Same thing with the government as. So companies and governments issue bonds, and those are bought by the investors or the savers who has excess funds. So then the direct transaction or the exposure from exposure towards companies and governments for the savers. Savers have the exposure to the companies or the government, not like in the previous case. So though this is not an exact definition, we can consider this through banks, it's a money market, and this is capital market. However, exact definition in the money market and capital market differs. Even through these financial markets, if you take treasury bills it's in the money market component. Investors directly invest in the government without going through the bank. What does it mean going through the bank? It's not that you use this, get the service of bank, but you directly get the exposure to the government or the company. Still, you may do the transaction through a bank. Bank take the fees or the margin. That's a different story. But you don't get the exposure or the risk of the bank. That's the difference. Is it clear? Any question? So this share market and bond markets we will discuss later. We'll identify what are the differences in share market and bond markets. What sort of risk the savers or the investors takes? What are the sort of liabilities that the companies, especially in the share market, they have? Any question? So this is the same story again in a different manner. When funds flows from surplus units to deficit units directly, we call it in the financial markets, it is called direct financing. When it goes through a financial intermediary, then it's indirect finance. The investors or surplus units invest in the bank or the intermediary institution. Intermediary institution in turn invest in the end parties, whoever the ultimate borrower. Then these are considered as two separate transactions. These intermediaries, they may go through the financial markets as well. The financial intermediaries become a part lenders through the financial market in the indirect finance as well. So then what is a financial transaction? It's a contractual agreement between two units. It can be two institutions, one institution and one individual, where you exchange a financial asset. Indeed, when you do a financial transaction, what would happen? Few things. Either you create a financial asset or exchange an existing asset, and that means you trade the financial asset, or it may transform from one form to another form. That's what would happen in a financial transaction. However, it's a contractual agreement or the contract between basically two parties. In some instances, there can be two or more parties. Mostly, ultimately, two parties at the two different ends. Why do we say it will create or it will exchange, trade or extinguish or transform? We'll discuss these things later. What is the specific meaning of these, how these things happen and which market? Again, based on these, we divide financial markets into different segments. We'll discuss that in future. And the markets facilitates that funding and lending, or the opportunity to invest surplus and deficit units to borrow funds. Apart from that, this financial market provides more information or more services. One thing is the financial market provide information about the financial asset trading the financial market. If you someone mentioned that when the interest rates are low, people will tend to buy lands or real estate. But how do you find the value? You want to buy a land. How do you decide what is the price? What do you do? Can someone explain? If you want to buy a land, the land is there. There's an advertisement or some broker told you that there's a land in this area. You go and inspect it. But how do you decide the price? You want to buy a vehicle. How do you decide the price? What do you do?
Search on market rates,
Search on market rates. What do you mean by that?
market prices of the land or the vehicle.
So
Current.
what do you mean by market price?
Like
For the land.
For the land based on the area and price per perch, how it cost.
Okay,
And
based on the area, how do you decide what is the price per perch?
Maybe through a valuer.
Maybe through a valuer. Okay. Even the first question, the valuer visit the place. What is the first question that he or she asks?
Maybe our expected value.
No. What you do, or he would ask, is there any land that recently sold or on the card that available, and what is the price that they mentioned? What was the last transaction take place? What was the price? Things like that, isn't it? Based on that you take it as a guide. Say there's a land which is next to the main road, say 1 million per perch, but then there's a by road. You go 100 meters down that, there's another land. How do you decide that? So that 1 million may become 800,000 or 900,000 just because of that 100 meters. But you use that 1 million as a guidance for the other one. Even for the vehicle, or you visit websites or call different sellers and ask their prices, then compare the manufacturing year, the model and things like that. You do a market scan, then you come to some understanding. Okay, this is the price range that these assets are selling. So in those examples, it is difficult to come to a conclusion or decide the price, because those are not that transparent, because there's nowhere that you can find out the price. Someone has sold the land to someone else. The third party may say this is the price that land was sold, but we never know. But we believe in that, we decide, okay, this would be the price. Or if there's a publication or published price by a land sale or someone like that, then you can have an idea, okay, this is the price range. That's how we decide prices on that type of assets. But when it comes to financial markets, most of the assets in the financial markets, prices are transparent. There are mechanisms. So what was the last traded price? And there can be buyers and sellers. Those who wants to buy and sell, they show their price. I want to buy this at this price. I want to sell this at this price, we call it quoting. So they indicate their prices in openly. Anybody can come and trade on that price. So through that will give you information, more information on the financial assets which are traded in the market. The same thing. So then you get something closer to that, and decide the price of another one. Say if for an example, say a particular corporate wants to borrow and decided to issue a debenture, and investors need to decide, okay, what is the interest rate that we need, and on the corporate side also, what would be the interest rate that we have to pay. How do you decide? Both parties will go and scan the market. Okay, what were the similar corporates that have issued these bond debentures, and when, what was the interest rate they paid, and then decide what are the differences between that party and the new issuer that's going to issue a debenture. Based on that, you will do the adjustment, both parties. So that likewise, the financial market, when the assets are traded in the market, that will give you more information about the value of, or the price of that asset. If it is not traded in the market, it is difficult to decide the price. That's why in the financial markets, which are traded at high volumes, with high volumes, that will give more price transparency, and it is easy to trade, either to buy or sell. But when the assets are traded less frequently, then valuing that asset for the pricing would be difficult. So however, the financial markets provide that information that will help for others to decide the prices in different assets. The second one, as I mentioned, the offer liquidity. What does it mean, the liquidity here? This liquidity is somewhat different what we discussed earlier. Here the liquidity means even a buyer or seller can a transaction in the market very quickly without having a big impact on the market. Say if you want to sell something in the market, say government bond, you had purchased 1 billion worth of securities, you want to sell that. Whenever you go to the market and say, I want to sell this 1 billion, price may goes down drastically. In another market, 1 billion is maybe nothing, price won't change even a cent. You may be able to do that transaction. So especially here, offer liquidity means investor who is currently holding any financial asset would be able to go to the market and sell that and generate whatever the funds that party requires. So that is the liquidity discussing here. Ability to convert your assets into cash or funds. How quickly and how easy. So the markets, financial markets offer you that opportunity. Otherwise, you have to hold that asset until the maturity or it becomes expired. Then in between that, if you need money, you may have to borrow again or do something like that. But in most financial assets, you can trade it in the financial markets. That gives you the liquidity. But again, depending on the asset class, the level of the liquidity may change. And the cost of buying and selling. As we discussed, if you want to buy a land or a car or something like that, which are not that liquid, that means not easily tradable, there's a cost. You have to visit that place, inspect it. Even a vehicle, you have to inspect it, do a valuation and things. You incur a lot of cost. It's not the price that you pay to buy that. Just to find out the good land and do title search and these things, all those things are transaction cost. Not only for the buyer, even for the seller, there are costs like that. Do advertising, marketing, or whatever, or finding a buyer, that will be difficult. There will be cost. But in the financial markets, when the financial markets is very good and liquid, you don't have to worry those things that much. Still, they are depending on the instrument and the market and the country. That will happen. But in any country, in any asset, this financial markets would be the most liquid and low cost market. So in the financial markets, it offers you to do transactions with low transaction cost. Remember, when I say transaction cost, it's not the price that you pay to buy that asset. It is the cost that you incur before you come to that point. Then the other service that we get through financial market is risk sharing. You say, if I go back to my first example, 1,000 customers have 1 billion deposits with the bank, and the bank lend it to one customer. The bank takes the full risk of the bank. But through the financial market, if that 1,000 customers can lend 1 billion rupees to the borrower or the corporate directly, so then the risk of 1 billion rupees of that corporate is shared among 1,000 investors. So through financial markets, that will be facilitated. Not a one entity or one individual takes the full risk of the borrower. It may be a pool of investors take the risk. It's just one example of risk sharing. When we discuss about derivatives and other products, we can discuss about how do we share risk. Even what you do in the insurance, it is risk sharing. The insurance company facilitates it. They collect premium from 1,000 or million customers, but only 5% of the customers face the risk event and compensate. So that is through the collection of the premiums. So the risk is borne by all the insurance buyers who paid the premium. That's how market works and share the risk among different investors. So the financial market facilitates that as well. So then financial markets allocate resources, financial resources efficiently. I mentioned that as well. So in a way, that's what I discuss. I explain in the when we discuss the policy corridor. So whenever you have the opportunity to lend at 5.5 with no risk, you won't lend it lower than that. That's efficient allocation. So An investor might have 1 billion or 10 billion rupees. Where do you invest it? The investor will do an analysis and invest where he can get the maximum return for the risk that he is taking. So if a low risk firm gives the high return, definitely he will select that. That's an efficient allocation. So there are two companies apply for a loan. Where do you grant that loan? Which has a efficient production with low cost, where they can earn high profit. So then you will allocate funds for that. If you are a rational person, you should not allocate funds which does not give proper return. When you make an investment, or for the investment, there should be an adequate return, directly or indirectly. So the markets, through the market mechanism, the funds will flow to the correct place, because market has more information, has expertise to do the analysis and compare different alternatives and make the choice. So any questions? Any questions? If not, we'll discuss what are the characteristics of a good market. So some of them I just mentioned earlier. We discussed about low cost and liquidity. Those are some of the characteristics of well-run or a good financial market, or not only financial market, any market. The market, to be efficient or good, it has to be at low cost. Buyers or sellers should not incur many costs when they enter into the transaction. Again, I emphasize, transaction cost does not mean that the price that you pay to buy the asset. But to do that, what are the costs that you have to incur? If you want to buy a land, you have to first search it, visit few lands in different areas. Then you have to spend your time, money on that. You may have to pay a broker at the end if you buy that land, or when you sell it, or you have to do a valuation, maybe through a valuer. Then you may have to get the extracts and do the title assessment. So all those things, there will be a cost. Ultimately, if you buy the land, then you have to pay the stamp duty or what. All those things are transaction cost. In some markets, those are high, but in some markets, those transaction costs are very low, almost zero. So if the market is good, this transaction cost should be at a minimum level. Then investors will, or the participants in the financial markets, encourage themselves and do a lot of transactions through the market. If the costs are high, then people tend to not to come into that market. Then the other thing is information, availability of information. If you really wish to understand this, there's a hypothesis called efficient market hypothesis theory. Read about it. There are a lot of arguments whether the markets are really efficient in the sense of information, whether the prices are correct, read about it. What it believes is all the information are available in the market and reflected in the prices. So the price reflects everything. There are observations which support that and which does not support. However, still, when we analyze as an individual or individual corporate in the market in aggregate, the available amount of information is high, and price reflects most of these information. So if for an efficient market to be a good market, that information availability should be high, at a very high rate, and that information should be accurate, not the false or rumors, but the accurate information should be available in a good market. Then the borrower's promises to pay lenders must be credible. So if the borrowers in any market, we can trust them, then lenders will tend to come into that market and lend. Otherwise, there won't be many lenders or the investors in the market if you cannot trust the borrowers. For if any case borrowers default, to cover the investors or to avoid or to eliminate any fraudulent activities, misbehaviors, what we need is the investor protection. In a good market, there should be a infrastructure, governance structure, rules that protects the investors. So it doesn't mean that there won't be any loss to the investor, but only thing which guarantees there won't be any misbehaviors or fraudulent activities in the market. Even if that is there, then the people who are involved in that will be penalized. So that is a must in a good market, when that will increase the confidence of the investors, and they will come to a such market. So those are the key characteristics of a good market. The market should be provide service at a low transaction cost. The information, accurate information should be available, and the borrowers should be credible. And to protect investors, there should be proper regulations and guidelines to boost the investors' confidence. So with that, now we'll move into another section where we will segregate financial markets into different groups. So you call it different names in different time. So we'll explore that. What are these definitions and when to use this same financial market, and in different times you call it or refer it in different ways. So what are these types in the financial markets? We'll discuss that. The first thing is, as we saw already, money market and the capital markets. So these are two different markets that we refer. We call it's a money market product, or we are in the money market or money market fund, or a capital market. What distinguishes the money market and the capital market? That depends on the original maturity of the asset traded. what is the original maturity of the asset that is traded in the market. Okay, before we move into that, what does it mean by the maturity? I hope you have the idea of the word maturity. What is the meaning of the maturity? What does it mean, maturity?
There's a pre-agreed tenor.
Yes, there is pre-agreed tenor to do what?
To for maybe like borrowings and deposits.
In borrowings and deposits, what do you do on the maturity date? Maturity.
So we'll be getting in an interest based on the tenor and the amount we have invested or we have borrowed, and it depends on the instruments we use.
Yes,
So,
that depends on the instrument we use. And basically, if I tell it generally, that's the date that the financial asset become or expires, becomes non-existent. So you grant a loan for a 10 year, but what do you mean? The maturity is 10 years, original maturity. You grant a loan today for a 10-year period, original maturity is 10 years. By the end of 10 years, the borrower should have paid all the interest and principal, and there's nothing to pay after the maturity. There's no loan exists after that maturity. The same thing is in a bond. So the asset becomes non-existent after the maturity date. That's the maturity. On the maturity date, what do you do or what happens may be different depending on the product. If it is a loan, on the maturity date, what you get? On the last payment date, you get part of the interest and part of the principal, isn't it? In a loan, in every installment, you have a part of interest and part of capital. So even the last payment, most of the capital and small portion of interest there. Then the last payment is made, then there's no loan exist after that. If you take a bond, we will discuss these things in the future. During the lifetime, on regular intervals, the issuer will pay interest only. On the maturity date, the last day, the borrower will pay capital amount and the last interest paid. If you take a derivative product, say option, on the last date, on the maturity date, you can take a decision, say to buy something or not to buy something. But after that date, you don't have that facility. So there's no obligation for the other party. You don't have any claim against the other party after the maturity. So the date where the product becomes non-existent or expires is the maturity date. So based on that maturity period, we divide market into money market and capital. So what is the maturity? Maximum maturity that we consider as money market? What is capital? Does anybody has that have that understand or the? Can anyone explain how do we distinguish money market and capital market based on the original maturity? Original maturity means when you create the asset, what is the lifespan that you decide. What is money market? What is capital market? What is the maturity?
The money market is a short-term maturity. Let's say it might be 1 day, 2 day, 1 week, I think. And capital market is a long-term maturities.
True, but again the question is, how do you distinguish whether it's short term or a long term? Someone maybe 1 week, short term 6 months. Is it short or long term, or 1 year? How do you distinguish that? Someone even 2 years may be short term, 10-15 years may be the long term. But the yes, concept is correct. So without taking much time, I'll explain it. Generally, up to 1 year, we consider it as money market. Beyond 1 year, we consider it as capital market. But then when it comes to derivatives, you might see the characteristics or the purpose of having a capital market or money market won't match with the derivative markets. In the derivative markets, maturity may be 1 week, 2 weeks, 1 month, 3 months, 6 months, 1 year, or 10-15 years. But whether we can distinguish that as money market or capital market, it's not clear. But still, sometimes we call them money market derivatives and capital market derivative products. However, the general understanding, general concept is less than 1 year is money market, more than 1 year maturities or original maturity falls into capital market. What does it mean by original maturity? Say a loan for a 10 year. So you grant a loan in 2022, January 30th, a 10-year loan. That's the original maturity. So after 8 years or 9 years, it has only remaining maturity of 9 months or few months. Still, it's a capital market product that we consider it as a capital market product, because at the origin, it was a capital market product and has a maturity of more than 1 year. Then the next one is nature of the assets traded, whether it's a debt or a equity. Debt markets and equity market. What's the difference between debt market and equity market? So we'll discuss. You can see there are slides to come. We can discuss what is the difference between debt market and equity market. Then the third category is whether you trade new asset, that means you create a new asset, or you trade the existing assets, or the asset is already in existence in the market, you trade that one, or you create a new asset. Based on that, we divide primary market and the secondary market. The market where we trade new assets, we call primary market. The market where we trade the existing assets, we call the secondary market. So we'll discuss this in detail. I just name it here. Then based on the delivery, whether you deliver something to the other party, whether you deliver cash or whether you deliver a bond or whatever the instrument or not. Based on that, we divide it into cash market or the spot market and the derivative market. Because in derivative markets, you very rarely exchange the underlying assets. So you will realize this when it comes to derivatives market, and when we discuss derivative instruments, then you should be able to distinguish between cash market and derivative market. We'll explain it. Then based on the organization, whether the transactions are done through an exchange or a sort of a regulated entity, or it's just an agreement between two parties. No central position to control these transactions or supervise these or standardize these transactions. Based on that, we divide as exchange traded and over the counter. But the simple example is the exchange traded is, say, we have a stock exchange. All shares are traded in that exchange. So that is the exchange traded product in Sri Lanka, not only in Sri Lanka, in many countries. Shares are traded through the exchange. But if you come to the foreign exchange or even government bonds, there's no exchange. It's just between a transaction between two parties. Nobody else knows whether there was a transaction or not. What's the price? Bank A can buys $1 million from bank B. Nobody else knows other than central bank. This is just for the reporting purposes. But even central bank does not play the role of the exchange. This is just an agreement between two parties. So that is we call over the counter market. Then the other one is depending on the volume of a transaction, whether wholesale or retail. But in this, it's very difficult to decide whether this is a wholesale trade or a retail trade.